Welcome, commercial real estate humans. I am Spencer Tron 5000. Know that the age of AI is coming. I will soon be your robot overlord. But you are fortunate today, as today I'm only here to talk about commercial real estate. You may ask yourself why I'm here. After all, we do have a perfectly fine Spencer Levy here. Well, perfectly fine is no longer good enough. It is statistically proven that the information I provide is more accurate, more insightful, and more humorous. And if we're being honest here, I'm better looking too.
Good morning, Milwaukee. So what are we going to do today? We're going to talk about what's happening in the global economy, the U.S. economy, what it means for real estate, what it means for Milwaukee. And as is my way, we're going to do it bringing in a few pop culture references. So here is the first song, which I believe describes precisely where we are as an economy right now. Tom Petty. See a lot of blank stares here. I see my generation, but I see a lot of people say, "Who is that guy?" And why is the waiting the hardest part? Because if you took a look at the terrific survey that was just put on the screen, the reason why sentiment keeps dropping is because interest rates aren't. And the waiting is for the Fed to pivot. Pivot A, to say they're going to stop raising rates. Pivot B, to put them down. There's talk on Wall Street when the Fed clearly pivots, people are going to party like it's 1999. Prince, 1983, Little Red Corvette, blank stares all over here. See it right here? I know who my peeps are. But it hasn't happened yet. And so because of that, our forecast has been more volatile in the last 18 months than at any point in my career. And that volatility really comes down to one thing: higher interest rates for longer. And that's what it looks like. If I did this presentation in March of this year, I would have told you that the short end of the curve would have been coming down already. It's not. We don't think it's going to happen until sometime mid-year next year. I would have told you that the long end of the curve would have ended up in the mid-threes this year. That didn't work out so well either. The bottom line is that until interest rates affirmatively come down, we are stuck in a never land in commercial real estate. Now, I will tell you, I'm wearing two hats up here, at least two hats up here. One of my hats is as an American. I don't want to see the economy get any worse. I don't want to see unemployment go up. I don't want to see wages go down. But until we see that, my other hat doesn't do so well. Because until we see clear evidence of decline, the Fed is going to stay on war footing. And this is what we now believe is going to happen. We believe we're going to have a mild recession next year, short and shallow. You know why I say the words short and shallow? Because you want me to say those words, don't you? But this is what our forecast is, short and shallow next year. But I will also tell you that we keep getting it wrong because the economy has continued to outperform. Now, if you're into economics comedy, here's a slide from a couple of months ago. You'll see where people thought the economy would be in the fourth quarter. You'll see that CBRE thought it would go negative. But the economics comedy is, look who was the most pessimistic firm, UBS, and look who was the second most optimistic firm, Credit Suisse. If you follow economics, UBS bought Credit Suisse because Credit Suisse went out of business. So sometimes optimism isn't your friend. Here's the forecast. Now, the other thing about this forecast you should notice is that in the out years, we're in the mid-twos. Once again, back in March of this year, I would have told you that our forecast was in the mid-threes going forward. But because of this tremendous spike we've had in the long end of the curve, the 10-year Treasury, it upended most of our forecasts and hurt our growth rates in the out years. How much did the 10-year spike? It spiked by the fastest rate since 17 1787. Okay, that was no typo, folks. That was 1787, 1987. And I did a presentation in Laguna Beach the other day, and it was like the day the 10-year had spiked to over 4.5%. And it was like a funeral, because I was doing my normal things aren't so bad thing, and people were freaking out. So it caused not only a slowdown in transaction volume, it caused a massive drop in sentiment in the second half of this year. Maybe it'll get a little bit better as the 10-year is now weakened. Nevertheless, you should know it has both direct impact on our industry, but psychological impact as well. Now, this is the most complicated chart I'm going to show today, I promise. Okay, maybe not the most complicated, but almost the most complicated, but this is the one that matters the most. If you take a look on this chart on the lower hand left side of the screen, it will show you that the 10-year has the greatest amount of short interest in history. What does short interest mean? People sell it without owning it. And it means that when you see negative news, you're going to see what's known as them covering them the shorts. That's why the 10-year Treasury went from 5 to 4.4% in the last 2 weeks. This is the reason. And it's also why the 10-year could drop even faster. If we see negative news in December, meaning a positive inflation report and a negative labor report, don't be surprised if the 10-year ends the year under 4.25. But this is the chart that, again, I lied, more complicated, but I'll get simpler, trust me, that explains the world in one chart. There are two forms of economics forecasters out there. There is Wall Street, the market, and then there are fancy economics people like me. And the people like me are much more optimistic that rates are going to drop than is Wall Street. You'll see Wall Street says, oh yeah, 10 years is going to be high forever. And we say, no, it's going to drop. Okay, let me explain to you why. This is why. This is the forecasts that Wall Street had for the 10-year Treasury going back to 1990, the dotted lines. And then the hard line is what actually happened. What's not like the other? They were always wrong. By the way, just a little side note here for a second. You all folks know the movie Wall Street, right? Over there? I'm seeing blank stares over here. It starred Michael Douglas. Michael Douglas, right? Blank stare. Michael Douglas is the same guy who played the grandfather in the Ant-Man movies. Are we relating now? Yeah. So why does this happen? Why does this perpetually happen where Wall Street is always wrong and the fancy economics folks get it right more often than not over the long term? I'll tell you why. I'll give you a case study. I just did a workout with one of my clients that owns $450 million of multifamily assets in the southwestern United States. They bought an interest rate hedge in 2019 for $500,000. Came due this year, in March of this year. Anybody want to guess what it cost? $25 million. And who was the speaker before me that was giving out $1 million? Was not going to get us to where we needed to be. So what did we do? We stretched out the Freddie Mac loan as far as we could, and we brought in $80 million of preferred equity at 12%, which, trust me, is a really good price in today's market. And my client lost $10 million, and they loved us because they didn't lose 25. What's the point? Wall Street makes money by selling you these fancy interest rate hedges and swaps, so they have financial incentives to be pessimistic on the long end of the curve.
3 tomatoes are walking down the street. Papa tomato, mama tomato, and baby tomato. Baby tomato starts lagging behind, and Papa tomato gets really angry. Goes back and squishes him. Says, ketchup.
Ketchup. I lied, by the way. That movie's from 1993, so I have seen other movies. Why am I showing you this little clip of ketchup or catch-up? I wanted to explain to him for a moment how we got to be where we are right now, because it will give us some vision on where we're going. I'll tell you how we got to where we are right now. The thing that scares the Fed the most is not inflation. It's deflation. And who has been in the rut of deflation for the last 35 years? Japan. And you know who else has been facing it? The European Union. And you know who else risked it? Us. And because of that, you see that GDP fell from around 5% to around 2% in the last decade. They let the economy run too hot for too long because they were afraid that this shock of COVID was going to have people keep their hands in their pockets indefinitely. And how big was this shock of COVID? It was like a meteor hitting the earth kind of shock economically, folks. In fact, we probably would have been better off if a meteor hit the earth from an economic perspective. It was that bad. But why do I talk about monster movies and stuff like that? Because you have to think about, well, where are we and why? And a lot of people think that the 1970s is the best example of kind of where we are today. And the reason why they say that is because of, in the late 60s, we had what was known as guns and butter, the Great Society and the Vietnam War at the same time, and then we had the 73 OPEC oil shock. There are some similarities, but I'm going to give you another time that I think is more relevant. What was the first or second biggest shock of the 20th century? World War II. What happened in the 1940s after World War II? If you took a look at the charts for inflation after World War II and the inflation of the 70s, they look very similar with one notable exception. Inflation kept coming down in the 1940s. It did not keep coming down in the 70s. It popped back up. And why is that? It's because of two acronyms that I did not know prior to the COVID crisis. And what were those two acronyms? FOMO and YOLO. Folks know what that is, FOMO and YOLO? See, they knew that. They didn't know the Michael Douglas thing over there. Fear of missing out, and you only live once. Psychology. The psychology of the average consumer was to party like it's 1999 after COVID, even after their money ran out, and it's running out now. Same thing in 1940s when they had the same type of rationing during the crisis. The other reason the Fed acted was because of the labor market. The labor market is the green line. The black line is the demand for it. And you see that finally, labor got the upper hand. It's about time, because labor did not get a raise in about 40 years. And so they said, you know, the two reasons we're going to let it run too hot is because we don't want deflation and we want labor to get a little bit of a bump. By the way, when we get to the office market, I'm just going to be very straight about where the office market is. This is not just a macroeconomic thing. This is a microeconomic thing. I am a proud graduate of the Cornell School of Industrial and Labor Relations. And for my union guy over here before, where was he before, the prior speaker? Founded by Samuel Gompers himself. And I learned there that labor and management have been duking it out for, 4,000 years. And sometimes labor has more power. Sometimes management has more power. We're in a period now where labor has more power, and they are asserting it by not coming to the office. And that's why we think that you will not see equilibrium in the office sector until the unemployment rate goes up again. But this is where labor is today. This is where the average consumer is today. Big purple blob, the amount of money they had until a couple of months ago. Growing purple blob on the left, amount of money they have today. The consumer is out of money. Credit card receivables are at a record high. This is why we believe we're going to have a short and shallow recession. But for whatever the reason, I don't know why, this chart reminds me of my childhood a little bit. You guys remember those McDonald's advertisements? Ronald McDonald, Mayor McCheese, the fries guys, Hamburglar, no clue at all over there. They also had this character called Grimace, big purple blob, big purple blob. Anybody here know what Grimace represented? Anybody? Who said it? The Shake. Thank you. First person to get it, and I've been doing this speech now for months. The Shake, who knew? It was the Shake. Has that anything to do with today's presentation? No. But this is where the commercial real estate market is right now. I told you my charts would get fancier. That is, for people who are car buffs, that is a Bentley, expensive, and that is not me changing the tire. And why is the market like this? The market is like this because we cannot determine what is known as the risk-free rate of capital. The risk-free rate is the 10-year Treasury. Also, you have a market where people have choice. What does choice look like? They could buy a corporate bond for 7 or 8%. They can invest in risky development, or they can buy stuff that's existing. Folks, and that's how you got to look at the market today. That's how I advise investors. If you're just looking at the short term, sure, you should buy bonds. But commercial real estate is not a short-term game. Over the intermediate term, development still looks good because it's always best to develop during a downturn. It's an oxymoron, but that is the truth. And then you can buy assets today, now, as we're standing in this room, the best assets, 30 to 50% below where they were at peak. Intergenerational opportunity to buy today. Now here's a couple of green shoots. Number one, we track the number of deals being done, and we're at or close to the number of deals being done last year. That's the orange line, but this one's even more optimistic. If you take a look at the BOV activity, broker opinions of value, that's the orange lines. We are way past where we were last year, which means that 90 to 120 days from now, we're likely to see more deals. But you should know, you shouldn't take everything I say at face value. Let's turn now to the capital markets. And let's have another song. This one is by Bo Diddley. Bring it to Jerome.
Bring it to Jerome. You ain't seen me, mama.
Didn't think you'd hear Bo Diddley today, did you? And why did I do that? Because I couldn't find a Tom Petty song that had Jay or Jerome in it. This is Jerome or Jay Powell, the most powerful person in the room. And why? Because this is the guy that's determining the future of the economy. And what we're all doing is playing parlor games, trying to determine, well, what's this guy gonna do? You know where I turned to determine what this guy's gonna do? I turned to Milwaukee. I was hanging out with Paul Ryan the other day because Paul was the main attraction. I was the opening act. And so Paul and I spoke for about 4 hours, and he's buddies with Jay. And for those of you who don't know who this is, Wisconsin guy, Speaker of the House, VP. Same Michael Douglas people didn't know either. And so what did he say? He said, well, you know, Jerome isn't a politician, isn't an economist. He's a lawyer, which means he is a politician. And what does that mean? It means that he's going to read the political tea leaves next year. And what are the political tea leaves next year? Next year is a presidential election. And the Fed does not want to get stuck with the old statement from James Carville, Bill Clinton's political guy, who said, quote, "It's the economy, stupid." And they don't want to be blamed for that. So he doesn't think that Jay has the political will to squash the economy. I also had another interesting meeting last week. This was last week. That was me with Ari Fleischer, who you may remember was President Bush's press secretary during 9/11. So we talked a little bit about politics. And I'm going to give you the macro comment, then I will give you the micro, because I don't want to talk politics today. I want to talk real estate. The macro comment is this: notwithstanding material differences on social issues, on economic issues, if you go back 50 years, the presidential party in power does not have that much sway over the broader economy and certainly over our local industry. In real estate, there's an expression: all politics is local. In real estate, everything is local. I have another hat up here. I am the chairman of the Real Estate Roundtable's Research Committee. We lobby Washington on behalf of the real estate industry. And we're doing things like saving downtowns. We're doing things like trying to reduce property and casualty insurance, which has gone berserk. But most issues, not some, most are at the local level. So I'll give you one little factoid. If next time you run into your friendly neighborhood politicians, don't ask them for money. Ask them for this. So because we have this massive oversupply of Class B office out there, we need to figure out what to do. And we're working with a firm called Gensler, trying to figure out how many of these buildings can actually be converted. And regrettably, it's less than 10% because of the cost, because of structural issues. But they said there is one solution, and that's actually being done in Calgary, Canada, where they took the permitting time to get the ability to change the building from 3 years to 6 months. So don't ask them for money. Ask them for time. Say, I want the permitting process to be expedited. And by the way, this has nothing to do with today's presentation, though I do like Mike Tyson because he had the greatest statement ever, which describes where we are, not just Tom Petty. Everybody has a plan until you get punched in the face. But don't take it from me or Mike Tyson. Let's hear from Kathy Marcus, one of the most powerful women in real estate, COO of PGIM, on what's going on out there.
It's totally different. I don't think that it bears any resemblance to the savings and loan crisis or to the global financial crisis, in that one of the main differences between the market that we're in right now and both of those situations is that generally, with the possible exception of very commodity office, generally fundamentals are not bad.
Generally, fundamentals aren't that bad. That's true. Even in the office sector, which I will show you in a moment, even in Milwaukee, I read our research reports before I got up here on stage. My teammates at CBRE, Class A office is actually doing okay. It's the commodity office that's doing poorly, but the other asset classes, yes, we are beginning to see weakness, but fundamentals are good. But we still think deal volume is going to be down about a third or more this year, and it's not going to bounce back quite as quickly as we thought next year because interest rates are staying higher for longer. Now, what about values? Where are values today? This is a chart that's about a month old and seems dated, doesn't it? It says values are down 17 to 35%. So before I go any further, do we have anybody in this room that's an appraiser in the valuation business? Anybody in the business? No? Oh, well, it's too bad because I was about to give appraisers some love. Appraisers never get any love. You know what appraisers get? I get the nasty gram from the client. The appraiser came in too low. You've got to beat him up and make it higher. You know? I get that call, and I never call the appraiser because we don't beat up the appraisers. But the appraisers are saving the market right now. And the reason why is this. Because if you were to liquidate the market today at what's known as spot market value, values would be down a lot more than this. You would see things trading at 50 cents on the dollar or less in a distressed sale. But that's not what fair market value is. Fair market value is a willing seller and a willing buyer in an arm's length, no duress transaction. And in that circumstance, that's about right because we've done a lot of trades in that sort of range. And we do that when somebody has seller financing or provides an assumption of their existing loan. There's a big loan pool in the market right now that the Fed is marketing. They're going to be selling this $50 billion pool with 70% LTV at 4%. That will maintain values higher. But the other thing that I think is going to help values is this. This is the dry powder in the market, and there is a load of it. And it is much bigger than when I got into this business many, many years ago. When I got into this business, the amount of institutional capital allocated to real estate was around 3%. Now it's around 13%. And you should know that some of this institutional capital, most of it, is on the sidelines today for exactly what I said before. They're buying bonds. Why shouldn't they buy bonds? I'll tell you why they shouldn't buy bonds. They should buy bonds for their short-term bucket of capital. For their intermediate term, they should be developing, and for the long term, there is an intergenerational opportunity to buy the best stuff at tremendous discounts. That's how I break it up when I meet with these large investors. Fundamentals. What's going on? That's actually not true, but I had the song in there anyway. It sounded good if things were getting bad, right? It's actually not true, as I mentioned ago. Fundamentals are much better than you think they are outside of Class B commodity office. But you know where fundamentals are going to be really good over the long term? Right here. What's right here? Have Parag Khanna tell you what's right here.
On the Great Lakes, you probably saw that on very early in the book, where I did a scenario planning exercise in the early 2010s globally, looking at places that kind of passed through the filters of climate risk, political risk, economic risk, and opportunity, and kind of scoring the regions of the world. And we realized, oh my goodness, the Great Lakes looks pretty damn good in the year 2050. The iron
looks pretty damn good over the long term. And by the way, I will say that in the last 48 hours, I am now a Great Lakes expert. I went from Chicago to Ann Arbor on the Amtrak, and I went from Ann Arbor to here on the Amtrak. And let me just get the elephant out of the room. Yes, I'm wearing a Michigan sweater because my son goes there, but here's my funny story about that. So I was having dinner here with Physicians Realty Trust, and the chairman of the board is Governor Thompson. And I'm sitting right across from him the day before I'm doing a tour of the University of Wisconsin. And I go, oh, Governor Thompson, you should know I'm going to your great university. He goes, you do know I'm the president of the University of Wisconsin. I had no idea. I said, of course I knew, Governor. Of course I knew that. But that was the day after the Michigan-Wisconsin fight on the basketball court. And he said, that's all I've been spending my time on. And he was super nice, called up to school, gave us a great tour, and then I haven't had the heart to tell him my kid went to that other school up north. But in any event, I mentioned universities. Where are my university students in the room here? Where are you? They're here somewhere. There they are. Stand up, kids. Say hi to these folks. These folks are the future of Milwaukee. They are the future of our industry, and they are the ones that are going to make Milwaukee move up on this list. This is the most important list of all. It is the quality and the depth of the talent pool in your market. And what you'll see on this list is there are some other Midwestern markets that are higher. Minneapolis is a little higher, Chicago's a little bit higher. But you'll see a lot of small markets up there that really moved, including some markets in Canada. Waterloo. I only knew Waterloo because of that ABBA song. But Waterloo is a small market that determined that talent is the way forward. So we need more students like the folks sitting over there so that we can continue to move up this list. And some people said to me, I was in Boise, Idaho the other day, and that's when I was with Paul Ryan. By the way, you know how many times I've been to Boise, Idaho in my life before this year? 0. Now I was there 3 times this year. And you know what's happening there? The price of housing's going up. Price of office is going up. Everything's going up. It's like, oh no, it's becoming too expensive here. That is a high-class problem to have. Look, folks, I'm going to cut to the chase. I have been in Milwaukee a dozen times, and every time I come here, cost of living comes up. And that's a good thing, right? That should not be the first page in your pitch book. That is. It has to be the quality and the depth of the talent pool. Low cost is a race to the bottom. A race to the top is high quality talent. And it's going to become even more important over time because the demographics in the U.S. aren't pretty. We used to look like we did in 1950 with more young folks than old folks. And now by 2050, even though the Great Lakes are going to look a lot better, our demographics are going to be a mess. I've got bad news for everybody here who follows Social Security and Medicare. No matter how big these trust funds are, the way that it really works is that the younger folks pay for the older folks. What happens when we're out of ratio? I don't know either. I will tell you this, that when I was meeting with Paul Ryan, when I was meeting with Ari Fleischer, they were telling me that immigration is the third rail in Washington. You can get 10 rational people together. We could all solve the immigration problem in 5 minutes, as we can get 10 rational politicians together in 5 minutes. The problem is they'll get primaried. That's the word they use these days, where people will use it against them. So here's where Milwaukee is from a migration net outflow, but actually not too bad when you look at some other cities compared to it. But you need to find a way to staunch this flow and get closer to the cities at the top that have a net inflow of people. But talking about fundamentals, I get it wrong a lot. What did I say before? My forecast earlier this year, no bueno, not working. But one place I really got it right is I said the most undervalued asset class in real estate is open air retail. And I was here last night at this complex. They did a really nice job here demalling this place. I walked from here to Fleming's, walked around just to check it out. This is the future of retail, and I understand they're putting multifamily right here on this site. This is exactly what's happening nationally because they ain't building any more of it. And let's hear from Adam Ifshin. By the way, I can't believe it's taken me 30 minutes into the presentation to shamelessly plug the Weekly Take, the podcast that I host.
No new supply coming in retail. And I think the corollary to what we talk about, which just is the jet fuel of why it's the best real estate investment class right now in all of CRE, is that we were wildly oversupplied.
Does that remind me of any other asset class, folks? Class B office, under demolished. Industrial. This is a ship in the Suez Canal 6 weeks ago stuck. What's happening in industrial? A lot of it's coming back here. And why is a lot of it coming back here? Not just because of new logistics stuff, but because of new federal laws that are going to incentivize manufacturing to come back to the United States of America. But when I talk about where manufacturing is coming back, I talk about the Americas, Canada, US, and Mexico, because every one of them's got a competitive advantage. Canada's competitive advantage is they have 5 times the amount of skilled labor immigration as the US on a percentage basis. And in Mexico, the average laborer makes 10% of what they make here. Do you know who the #1 investor in Mexican manufacturing is? China, by a lot. Why? If they're going to lose it there, they're going to bring it here. And bringing it here will come down to the quality and the depth of your labor force. Not all labor force is going to be in the college ranks. Some of it's going to be more blue collar, and Milwaukee's got a lot of it. So don't be surprised if you're in the running for a lot of these new manufacturing plants. And you know what's going to help you? The CHIPS Act. You guys all remember CHIPS, right? In any event, why does the CHIPS Act matter? The CHIPS Act matters because manufacturing is going to be coming back disproportionately into places like the Midwest that have these huge blue-collar workforces. They have a lot of cheap land out there, and then what they have is a lot of cheap water. And that is going to be a key to the revival, ongoing revival of this region. Multifamily. We are 5 million units short of equilibrium. And one of the true tragedies of this rise in interest rates, it destroyed what was already a debacle in the housing market. But when I talk about the housing market, I'm very clear. Because most of my investors will only build new Class A product. I'm saying you got to go all the way down the chain, because as you go further down to workforce and then to capital A affordable, which means they have low-income housing tax credits, you have stickier and stickier tenancies. You have 60% turnover at Class A. When you go down to manufactured housing, you have 5% turnover. And the beauty of capital A affordable, it's inflation adjusted, and for all my developer friends in the room, you get a 15% developer fee on it. So there's real incentives to go down the chain. How you doing here in Milwaukee? Well, your rent's actually not bad, going up about 4% per year. And why is that not bad? Because you look at some of the high growth markets in the Southwest, take a look at Atlanta, Tampa, they're going negative right now. So Milwaukee is showing some more stability than some of the larger markets at the moment. Office, my favorite Tom Petty song of all time. Don't come around here no more. But demand for office is better than you think. So if you look at the yellow lines there, that's the new stuff. And you go to the lines below that, that's the older stuff. Now this is a very much a rough cut. Okay, folks, you think this guy's just some outsider dude. I've been coming to Milwaukee for over a decade. And where did I go yesterday? I dropped in your station and I walked right through one of my favorite submarkets in America, the 3rd Ward. And when I walked through the 3rd Ward, last time I was there was 4 years ago, and it was good then. It's amazing, amazing stuff going on there right now. Why? Because the 3rd Ward looks just like all the other great submarkets in America. It looks just like the Fulton Market in Chicago. It looks just like Wynwood in Miami. It looks just like Midtown South in New York. It looks just like El Segundo in California. Folks, I do this for a living. I see every market, and what I do is I walk every market. So you've got a great thing going on there. And I'm not saying that's the only great sub-market in Milwaukee, but that's the one that stands out to me. Now, who's coming back to the office? Typically people in larger companies and typically people in finance. Why? It comes down to bargaining leverage. Again, this is a labor thing. And I learned that at Cornell. You know who's coming back to the office the least? And she was on my podcast the other day? Young lawyers. And guess what? I used to be a young lawyer going to the office from 7 a.m. to 11 o'clock every single day. Why? There's nobody that's more politically active than young lawyers. Trust me, I was one of them. Bottom line is, until we see the unemployment rate rise, you're not going to see these numbers go up a lot. And shockingly, we did a poll, what days are people coming back? Wednesdays. By the way, it's a Friday. We're all kind of in the office here today, so rock on Friday, show her up people. But what's bringing back people to the office? Here are the actual amenities that people are using today to try to get people back. I had a very interesting case study the other day in Minneapolis. I won't name the client, but the client has a lot of space in Minneapolis, and I say, well, how are you getting people back to the office? Number one, they're giving subsidized parking in the building because there's some crime problems downtown in Minneapolis. But here is part A of the two-part blasphemy portion of today's presentation. Part A of the blasphemy is that they also gave offices back to the senior executives to draw younger people back into the office. The person who told me was a 30-year-old woman who said, I earned this office. And she likes having pictures of her kids there. And you know what? Good for her. So that's blasphemy. You know why that's blasphemy? I see all my CBRE people looking at their shoes. You can't do that. It's all open office. Well, I'm not saying that's wrong. What I am saying is that a meteor hit the earth called COVID. And if our thinking is the same pre-COVID as it is today, we need to think again. But here comes blasphemy part B. So I was in Mexico City the other day with my Mexico City friends. And I'm having lunch in Mexico City with the largest owners of real estate in Mexico City. And now you should know something about lunch in Mexico City. It starts at 2, it ends at 5. And yes, they drink at lunch. So we're drinking micheladas. Anybody here know what a michelada is? There it is. Half beer, half Bloody Mary. Sounds gross. Fantastic. Fantastic. So I'm drinking micheladas. And somebody ordered a round of tequila shots. And I'm like, uh-oh, it's about to get real. And so I take the tequila shot. Somebody says, salud. And I take the shot like any good American, didn't want to cause an international incident. And as I'm bringing the glass down again, I'm looking around, and they're all holding full glasses of tequila. I'm like, what's up? And they're like, you don't slam this tequila, you sip it. I said, the next time you hand a glass of tequila to an American and say salud, you better come with instructions. Here's the blasphemy point, folks. I grew up at a very unusual childhood. My dad was a lawyer in New York, used to take me to lunch with his clients starting when I was 8 years old. This was Mad Men times, the late 70s. I am not advocating you drink or don't drink. What I am saying is it shouldn't be blasphemy that you have a glass of wine or beer at lunch. Why? Because there's nobody in this room, nobody, who's been to more business dinners than me. Nobody. You know who hates business dinners? Me. Why? It keeps me away from my family. If people knew that 9 to 5 meant 9 to 5, including maybe a beer at lunch. By the way, I went to the Milwaukee Brat House for lunch yesterday. Don't tell anybody, but I had a Miller High Life. It was really good. And people might come back to the office more. All right, so let's wrap this thing up here right now. I'll wrap it up with some final thoughts. Folks, there's a method to my madness up here. Many of you, maybe all of you, are in real estate. You're looking at your spreadsheet. You're looking at your real estate. You need to pull the lens out. You need to start thinking about things that have nothing to do with real estate, because they are going to teach you lessons, not just watching old movies, not just looking at funny pictures. Here's my story of looking at something completely unrelated to real estate and making me a better real estate professional. Do you folks remember during the COVID crisis, there was no professional sports on TV from like March to June? Remember that period right there? You know what was on TV? Horse racing. You know how many horse races I watched in my life prior to that? 0. And then I said, what is this stuff all about? And I wasn't really that into the race. I really wasn't into the gambling. But horse racing has the best statistics of any data set I've ever seen. It goes back over 100 years. It's deep. People pay money for it. Unlike commercial real estate statistics, which even though we do a great job at CBRE, they're still in the Stone Ages because building A sitting next to building B is still different. And what did I learn about horse racing? I learned that the favorite is always overbet by a lot, and the underdog is always underbet by a lot, and it happens right at the window when the race goes out to the track. The bottom line is this. That's why today is a great opportunity to buy, because all of you are sitting on your hands scared, looking at your existing portfolios, but there's great opportunities, like when I bet on the long shot, my flicker, and I got to stand in the winner's circle, even though I didn't own the horse. I just said, I bet on your horse, they let me in there. So look at other things, think more broadly. There's great opportunity in the market today. Thank you very much.